Hey there, it's Mike Langford. Welcome to the Augmented Advisor Podcast, brought to you by Blue Leaf. This week on the show, John Prendergast and I are joined by Ian Karnell, the Chief Revenue Officer of Truelytics, for a high-impact conversation that just might help you put a few $100,000 in your pocket. Now, I know that sounds nuts, or maybe like one of those get-rich-quick seminars, but come on. You know how John and I roll. We aren't the type of guys to overhype stuff. What you're actually going to hear in this conversation with Ian, John, and myself is that by analyzing your business in a systematic way, you're likely to discover tangible, unrealized value that translates directly to your bottom line. So quick, run and go grab a notebook and a pen. You're going to want to take notes for this one. Before we get started, please take a moment to subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or suggestion for a topic or a guest for the show, please feel free to reach out by shooting us an email at podcast@blueleaf.com or swing by the website or hit us up on the socials. Blue Leaf, John, and myself are all active on LinkedIn and Twitter and Facebook, and we're super easy to find. Okay, let's get to a conversation with Ian Karnell.
Ian from Truelytics. Welcome, buddy. How are you?
I'm well, thank you. How are you guys?
Fantastic. It's great to see you.
Good to see you guys. Always.
Exactly.
It's always an adventure.
Okay, so listen, dude, we're absolutely thrilled to have you on the show. I've been looking forward to having you on this podcast ever since we launched it because the topics we're going to be covering today are very, very important to the RIAs and independent financial advisory audience as a whole. And a lot of this stuff has been very current, right? So, as an example, according to Cerulli Associates, nearly 40% of today's financial advisors plan to exit the business in the next 10 years. And if that's true, this means we're going to see a huge amount of churn in our industry. And Truelytics was founded about 5 years ago, in part to help with what you've defined as this great wave of transition that's coming. What are you seeing as some of the core pain points for advisors and wealth management firms they're going to need to address these pain points in the coming years as this wave manifests?
Yeah, I think certainly we see the need for advisors and advisory firms in understanding those variables that drive value for their business as they begin to think about succession planning, as they begin to think about, what do they do with what is typically the most valuable retirement asset that they have. And it's ironic because most of them, not all of them, have treated it like a lifestyle business. And it's afforded them an amazing lifestyle. But as they've gotten older, certainly there's a segment of advisors that we see are planning to stick with the business until they don't wake up the next morning. You definitely see a segment of advisors not thinking about doing everything they can to maximize the value of their firm to set it up for a transition. Some absolutely plan to continue with the firm as long as they can until they don't wake up that next morning. and that's obviously a segment. It's not to define the category, and it's not responsible for the families that you're helping advise either. So I think that the smaller to mid-sized firms need to prepare for this massive consolidation that's going on. I think they need that, depending on their growth and exit activity, that they're going to have to understand value drivers in a way that maybe they weren't thinking about that before. And that was the impetus for why Truelytics was born, was to really kind of bring a spotlight to understanding value in this particular sector. Anybody can do a valuation calculation. That's not rocket science. You can, it's a spreadsheet with the ability to account for standard deviation, and you can come up with multiples on EBITDA, multiples on EBOC, back of the napkin type of calculations. And for the most part, a lion's share of the industry have been doing that sort of thing. What we're trying to do is to bring a little bit more sophistication in understanding what sophisticated buyers in this market are looking at from a value perspective. Nowhere do we see multiple of revenue even talked about, not from where we sit. That's not the core value driver.
Yeah.
We see predominantly discounted cash flow and EBOC because sophisticated buyers are disciplined and they understand that they're buying a free cash flow business, and they want to look at not just revenue and expenses. They want to look at risk profile. They want to understand the risk associated with the long-term cash flow that they're buying. And so bringing optics to that, bringing the ability to uncover data that is critically important for some of these firms to understand so that they can maximize their value and they can set their firm up for a successful transition. And that's to the benefit of their clients ultimately, right?
Yeah.
And that's something that is typically an afterthought in some of these things. I was in New York City last week speaking at a dimensional fund event at the Princeton Club, and we were talking about this exact topic. And one of the questions was, what happens typically in a structure with the principals of these deals? And I weighed in. I said, well, a lot of the structures allow for those principals to stay on board, mostly because they're motivated to do that. They're certainly motivated to want to make sure that their clients land and kind of where they're transitioning to, and that's good for the buyer, right? They want to make sure that they don't see the same attrition rates that typically kind of follow a transition.
You know, I assume, or I imagine some of the members of our audience are like 40%. That sounds a little high. But when you consider that the average age of today's financial advisor is somewhere in the neighborhood of 62, right? We know that the industry has had some challenges as of late recruiting younger advisors, younger people to come into the business. So we're seeing that age creep up, and we're having a hard time backfilling advisors who may exit the business. And here's the deal. Father Time is undefeated, right? Like, so you may want to stay with your business forever and, manage it and, until you don't wake up the next day. But the reality is, you will leave the business at some point in time here. And so that 40% doesn't seem that outrageous to think like, okay, if you're 62 now, 10 years from now, you're gonna be 72. How much longer past 72 are you gonna want to be doing this? And I think if you look at the data, you'd be very surprised at how many advisors are already in their 70s, right?
Yeah.
So there will be some exiting happening here. So it's natural for individual advisors and firms to be like, okay, I'm concerned, right?
Yeah. Well, so one of the data points that, with respect to exactly that we focus on, or that we articulate as part of these discussions, is that the financial industry is facing a shortfall of more than 200,000 advisors by next year. And in 2017, that prediction grew daily, and those within 15 years of leaving their practice have the difficult job of thinking about, well, how do they recruit? How do they train? How do they prepare for their retirement? And we see, one of the data points that we see on our platform is with one of our index model, our business stability index model. We see that like 46% of independent RIA firms already using our platform, Truelytics, have a business stability grade of C. And with respect to continuity, of those firms with a C, nearly 90% of them do not have a succession plan in place. The number jumps to 98% if there's no emergency continuity plan. And so it's one of the reasons we're seeing massive discounts to value. Just in those two areas, the lack of a succession plan, the lack of a continuity plan, the vast numbers of individuals that haven't even thought through and preparing those and thinking through what happens next. And that is impacting value. That is absolutely, that's one of the biggest impacts of value that we see from where we sit.
So Ian, connect the dots for our audience a little bit here. You hear succession plan, that feels very internal right? It feels like, why does a buyer care about a succession plan? How does that actually impact valuation? And why does that lower my retirement asset, the value of my retirement asset? So connect
Yeah.
those.
So we see, from where we're sitting, like with respect to inorganic growth on the buyer side, there are really kind of three legs to that stool. There's recruitment, there's succession, and then there's just M&A, right? And so with respect to succession, the buyers they understand that there's a segment of advisory firms out there that are not looking to sell today. They are beginning to think about, well, what happens next? And they want to make sure that in the event of either a unplanned succession event, they get hit by an Uber, that there's a path for a transition of their asset to NewCo or to the other individual at the other side of that succession plan, where there's some value being returned to their family. The lack of that succession plan is a risk from a business stability perspective. That's why that KPI is in our business stability index model. And that's where our index models, we leverage as part of our discounted cash flow valuation. Most DCF valuations use a weighted average cost of capital, a WACC, kind of to help determine the discount. We don't, because there's no really good public comparables to these types of firms out there. And so we've purpose-built these index models as a way to account for the nuances that are prevalent in this specific industry. And so we start with a baseline discount. I think it's 14%. And then each of the index models provide an additional maximum 5% discount to the DCF valuations that we do. So that's where business stability, we have between all three index models, we have about 50 KPIs that we look at, key performance indicators around business, client, and revenue stability. And these all pertain to risk and helping to quantify that risk for the buyer that's inherent in that business, beyond just revenue and expenses. And so not having a succession plan presents an existential risk to the asset. And so we simply ask the question, if the answer is no, then we absolutely apply our index model, our algorithms apply a premium discount to the DCF. So that's an easy thing to fix too. Like a lot of the KPIs within business stability are within the reach of a principal of that firm to easily remedy. And it has a massive impact. We see that. I can, when we get to this section and we start talking about unrealized value, I can walk you through the case studies that we have and looking at all 15,000 advisors using our platform. And what we see is the average unrealized value. And as I just stated, like the core drivers for business stability discounts are the lack of a continuity plan, the lack of a succession plan. And so there's a huge ROI for the principals of the firms to begin to think about, well, what happens in these events? What happens if I get hit by a car? Where do I want my practice to ultimately end up? I'm still wanting to work today and I'm not ready to sell this business. Having thought through that element of it de-risks the business, and having some formal succession plan in place will absolutely impact positively your value as a practice.
So to summarize for our DCF jockeys in the audience, it sounds as simple as, look, no succession plan makes the stability of the business lower,
right,
which increases the risk of the future cash flows.
Right.
That increases the risk premium, and everybody knows you increase the risk premium in a DCF and the value comes down.
Yeah, that's
There's the math, people.
That's right. And the good news is you can identify it and you can remedy it. And so what we've done is with the index models, we can quantify the impact, the actual dollar impact it's having on your discounted cash flow. I think that's important when a principal looks at, well, what are my priorities? What are the highest priorities I should make based on the most amount of money it's discounting against my DCF valuation and the ease of implementation. I mean, that's typically where you start. What has the biggest impact? That's the easiest thing for me to fix today. That is one of them. Continuity plan. Getting a continuity plan in place has the biggest valuation impact, and it's the most kind of it's not the easiest thing, but it's certainly, I mean, we have
it's
from an ease of implementation analysis, it's easy relative to everything else to go fix it. So there's no reason not to do that. But it helps, a principal of a firm understand, like, man, that's costing me $100,000. That's costing me, let me go spend a few $1,000s and let me have a formal succession plan written up, signed in a secure location that can be accessed when needed. So,
well, and coming out of a pandemic, frankly, that was disproportionately hard on folks who are older, and the average age of an advisor, again, being older, makes sense for you to have a continuity and succession plan in place, right? Because, if nothing shone a light on that risk like this, what we had this past 18 months, I don't know what will, right? It's crazy.
Right.
So Ian, one of the things that obviously also impacts the value of a firm and clearly the value of a DCF, particularly if you're talking about terminal value, is growth. And we got a really interesting stat from Kieran Bull, was with Price Metrics by McKinsey, just a few shows ago. And he shared that 75% of asset growth for advisors since 2015 was due to market performance.
That's correct.
Meaning most advisors aren't adding new clients or assets. And so they're mostly managing sort of lifestyle businesses.
Yep.
And when you think about the impact of growth rate on valuation, our sense is most advisors don't appreciate the dramatic impact growth rate can have on valuation. Can you share a little bit about how that weaves in here and sort of maybe talk about a couple of different scenarios with growth?
Yeah, well, I think it's interesting. And it's the type of growth as well. That's kind of an important nuance. So growth rate is certainly one variable, but it's also the type of growth. We see if the principle of the firm, if it's a growth through referral, like a high degree of referrals that are driven because the principle of the firm is on the critical path of that growth, that is actually a liability. That's a risk to the business. It's counterintuitive because you would think, well, I have a high referral rate, that should be good for the business. Well, it's good for the business as long as the principal is in the business. For a financially disciplined buyer, it's a liability. And it actually has a discount. It applies a discount to your DCF valuation. So the type of growth is critically important when we begin to think about growth and growth rates. So the scenario there is, or the remedy there is for the principals of the firms to begin to look at how do you operationalize growth beyond the principal? How do you build the right systems, the right funnels, the right acquisition campaigns that are not driven by a referral rate that is the result of a principal actively driving new customer acquisitions or new client acquisitions into the firm? That's critically important. You need to replicate that magic of the principle within systems and operationalizing that. So that's really important. I think that the other element is also the type of growth that you're getting. I mean, those firms that are getting the highest valuations in the market are those firms that have demonstrated their ability to grow into a diverse set of audiences, predominantly younger, right? I mean, I think when we think about the aging out of advisors, you also have to, you can't think about that scenario without thinking about the portfolio of clients that they're managing today who are also older, and the existential risk that presents to the business when you look at it's some ungodly number, 90+% of the heirs to an estate leave that advisor to find another advisors, right? And so it's really that's also kind of an important element of that growth. Are they doing a good job talking to the second generation, building relationships with the second generation. Are they doing a good job? So that's a retention metric, right? How do you mitigate that existential threat with respect to the heirs picking up their assets and moving to a different advisory firm? So that's a retention. And anybody who knows me from my role as chief revenue officer, always my number one priority is what's our retention rate look like? I don't even want to talk about acquisition until I know that we have nearly 100% retention rate, because that's the bucket. If you can't fix that, it doesn't matter how well you do on acquisitions. You have bigger problems. And so I think that's certainly a priority focus for advisors. The second then is beginning to think about, well, all right, how do I make myself relevant to the next generation of clients that I may not have now, because my client portfolio maybe disproportionately is weighted for older clients. How do you attract that next generation? What kind of new products and services will you roll out to be relevant to that audience? Can you begin to think about the household as a whole, not just as the individuals, the moms and dads leading the household that control the assets today? And how do you activate those dialogues so that you're moving beyond just having those single conversations with the asset owners today and beginning to talk about their children and involving their children, presenting products and services that get their children engaged with you to begin to build those relationships. So it's really important when we talk about growth rates, we go the step beyond, and we think about the type of growth. We think about how that growth is being generated. Is the principal central to the business? How do you address that? That's a risk that's driving discounts. How diversified are your clients? Have you proven the ability to be able to go and attract younger clients into your business? Those firms that understand those two nuances, and there are many more, but I just picked those two as scenarios for you, are commanding premium valuations in the marketplace.
So to summarize for our listeners, clearly not all growth is created equal, but growth that's dependent on a principle and not the business is particularly problematic, because it's exactly like buying a business with a brand name where the seller is going to take the brand name when they leave. So you buy the brand, but then you don't get the brand.
Well, it's also very similar to a concept we've talked about in the past, where you think of, as your example, your investment process, right? If the investment process you use to manage client assets is reliant upon all the wizardry that's up in your head, and you picking the right stocks for them, and every client's a special snowflake, and only the special sauce, that's going to be a lower value business than one that is using some model portfolios that any advisor who has some reasonable skill could come in and go through. Hey, this is what we do. Okay, great. I can manage that investment process, right? So the same is true for a marketing and sales process that drives new assets and drives new client relationships. If it's not something that somebody else can do, it's only relying on, hey, Ian walks into the room, he's amazing, everybody wants to hang out with Ian. Well, great, I'm not Ian. If I buy the business, I'm screwed, right?
Yep.
That's really, really important to keep that in mind as you're thinking about, again, especially if you're thinking about exiting the business or having a succession plan in place.
Right.
Yeah, and it's completely counter to what a lot of advisors get taught in terms of building the business, right? Clients are buying you, sell you,
right,
et cetera, and to a point, but this is saying, look, that's great to get the revenue initially, but if you haven't operationalized a way to make this about the business and not about you,
right,
the value of that asset that you've brought in is lower than it otherwise would be.
Well, and this is the reality, right? They're waking up to the reality that there are two hats that they have to wear. They have to wear an advisor hat, and there are certain physics to wearing that advisor hat and building those relationships and building that trust. But they also have to wear this business owner hat, and the business owner hat commands that they begin to understand the professionalization of their business and how to build a scalable, repeatable acquisition model that drives growth, how to maximize earnings, how to prepare for a transition, what's merger and acquisition readiness look like, and that's having command and control over all of the different variables, all of the different key performance indicators that will help you prepare for that and will help put you in a position to get a premium multiple in the marketplace. I find it interesting that there is a disconnect between buyers and sellers, and we'll talk about that. I think in a second, but so many of these of these advisors are kind of selling or thinking about selling for the very first time. They've never gone through this process before. They've never thought of their practice as a business the way a traditional business owner thinks about their business with respect to scaling, with respect to risk mitigation, things like that, and client diversification. And so this new hat of business owner is really kind of what is the catalyst for a lot of our growth as a company, Truelytics. Why our data is becoming increasingly important, why the insights from a practice management perspective are becoming crucial, and they're thinking about, for the older advisors, how do I maximize my valuation? For the younger advisors, they're just thinking very different from their predecessors. They're not thinking about this as a lifestyle business. They're starting by thinking as business owners. And I enjoy when I'm on the phone with some of these younger advisors, like just listening to them and understanding their mindset about how they're just thinking so differently about their practice than their predecessors. They embrace data, they embrace technology, and they want to leverage it to help drive regular optimizations, and it's great. So it's a different hat entirely.
Ian, the thing that brought up for me was in a lot of our conversations with advisors, even the language that they use is different,
yes.
Right? So advisors who have this mindset you're describe it as a business,
yep.
Right? This is a business. Even the word practice is a little foreign. It sticks in their mouth, right? And the more traditional sort of practice view tends, don't throw pitchforks at me, audience, but tends to be associated with folks who are thinking about building the business around themselves.
Yep.
Rather than independent from themselves.
Right.
And that becomes really problematic when you need to separate the business from yourself at point of sale.
That's right.
When you think about the word, other businesses that refer, or other professions where they call it a practice, right? We think about doctors and we think of lawyers primarily. I think of the ones that come to mind. Lawyers are billable hours. It's how much time do I have to bill you? Billable hours, right? If I'm not doing it and I'm not billing hours, I'm not making money. If you're a dentist, if I don't have my hands in your mouth, I'm not making any money, right? Like a dentist technically could take a nice vacation and let their hygienists or whatever do some stuff. But by and large, if the dentist isn't working, the dentist practice is kind of temporarily out of business. And so we start to think about it being a business owner, you need to have a scenario in which you can remove yourself from that business and it continues to operate and hopefully continues to grow, right? Because that's what somebody else wants. If they're going to buy that business from you, they're looking to buy something that can operate without you. So it's got to be structured that way. And it's understandable how many of the mature advisory practices that exist are our practices. It's because, most of those folks got started as stockbrokers, right? They came in, they owned a book of business, they grew it. They may have hired an assistant or whatever to help them manage things, but they own a book of business and they're practicing. And they never thought, oh, guess what? I'm going to be a business owner. Let's shift gears to something that you brought up a little earlier that I find particularly interesting, and I think many of the members of our audience will as well. You and the team at Truelytics have been beating this drum as of late, in the last several months, on unrealized value that advisors and firms have right under their noses, right? And that's a fascinating and exciting concept when you think about it. I mean, look, dude, I'm stoked when I put on a pair of jeans that I haven't worn since like last fall. And I'm like, hey, $20 is in my pocket. I found money. It's starting to get cool out. Found money. This is great. And the jeans, they fit nice still. It's awesome, right? So who's not excited when that happens? And when I think about finding, oh, you mean to tell me there's extra money in my business that I'm not taking advantage of? That's even better than the $20. Would you mind taking us through what you guys mean by unrealized value and how advisors and firms can go about making it realized value?
Right. So this is where I think we've taken some quantum leaps in our approach to valuation and our approach to going one step further to not just give a value number for kind of what the business looks like today, but really understand the optics of what's driving that valuation and more specifically, what's driving the discounts to that valuation and attributing a very specific number to that discount. And then being able to kind of stack rank all of the different discounts that were applied to your valuation from a discounted cash flow perspective, and use that as part of your practice management priorities. I mean, that's one of the reasons Investopedia selected us as an analytics platform for practice management this year, was that we're bringing these valuation insights into practice management for the first time and really kind of expanding the scope of practice management to consider value optimization on a day-to-day basis and what things that practice management can be doing to unlock that value. So unrealized value is value that is, is money that's being left on the table. It's money that was discounted from your valuation because of how you have built your practice, whether or not you have a continuity plan, whether or not you have a succession plan, what your growth rate looks like, how diversified your client portfolio looks like. Are you using model portfolios? Those sorts of questions, right? And based on how you've answered those questions through that valuation process, we can determine how much of a discount will be applied to your valuation. So quantifying that number and then specifically pointing out the KPIs or the specific ways that you built your business that are driving those discounts and how you should approach remedying that will unlock that value. So think about Zillow, right? So Zillow created home values for every home for homeowners in the United States. That's essentially what we're doing at Truelytics. I mean, we are Zillowfying the wealth management, insurance, and tax sectors. And so, by the end of this year, we will be in a position to have done valuations on almost every single IAR and RIA in the United States based on a new data deal that we're doing currently. And so we will have run all of those valuations. But unlike Zillow, so Zillow will give you the, 1Z estimate. We're going to give you 4 different valuations. Unlike Zillow, or imagine if Zillow could do this. Imagine if Zillow could say, well, if you built that extra entertainment room, you would have this type of impact to the value of your home. If you added a pool, you would have this type of impact on the value of your home. Imagine if Zillow did that for homeowners. That's exactly what we've done for these advisors and advisory firms. We've valued your practice, and then we can specifically tell you fixing X, Y, and Z will also drive incremental value. And this is how much incremental value. So that's essentially what we've done. And we want to educate the principals of these advisory firms as to what those drivers are. And we want to equip them with a roadmap of how to unlock that. So we did a case study this year. We looked at all RIAs and IARs on our platform. Okay. And we specifically only calculated for the business stability and client stability index models. We didn't calculate for the revenue stability index model because that's a relatively new index model for us. And we simply just didn't have enough data to feel confident in. We had some data, but it wasn't enough for us to feel confident in including that in the case study. So just out of the gates, we know that the numbers that we're presenting from an average unrealized value perspective are lower than what it actually is because we're leaving one index model out of this calculation. But it gives you a sense of the magnitude of money that is being left on the table. So when we looked at all 15,000 advisors, or nearly 16,000 advisors leveraging our platform today, and we ran these calculations over the last few years, we found an average identified unrealized value of $288,987.57. That's average. So there
I like
were
the sense part.
I mean, that's, and it breaks down between the two index models. Visibility represented $163,301 of that, and client stability represented $125,685 of that. And again, so next year, when we are able to calculate for the revenue stability, those numbers will go up likely. I mean, that's going to be significantly higher than $300,000 of unrealized value. When we look at it from a broker-dealer perspective, and when we kind of aggregated those numbers across all of the IBDs that are licensed on our platform, the number is significant. It is $276,409,122. That's when you're an IBD and you're thinking about your practice management capabilities and you're thinking about what value can I bring to my affiliated advisor network. Well, I mean, if the average value that your network is leaving on the table nearing $300 million, well, that's massive. Like, that's a huge value proposition that you can take into your advisory network, educate them on those value drivers, educate them on how to unlock that unrealized value, and put themselves in a position to reap the rewards that they've worked so hard to build over their lifetime and maximize the value of the firm.
One thing that's popping in my mind as we're talking about this is, that the advisors who are like, oh, I don't want to sell my business and so forth, and maybe I can put this off, right? This exploring valuation and why this is important for me for right now. One thing to keep in mind is, as we talked about earlier, like, well, this is a really important asset for you and your family. You might want to know what it's worth. But you don't have to sell your business to recognize and actually take cash out of the business, right? There are now lending options available to you where you can borrow some cash based on the value of your business, right? The business can actually, and you can take some cash off the table and buy that vacation house, expand the business or whatever. So it's not just about terminal value, if you will. And I know sometimes when we talk about valuation, people get a little squirrely when they think that way, like, oh, I'm going to do a valuation because I'm going to sell or I'm going to leave. And it's like, no, that's not the only reason why you do this.
That's absolutely correct. I actually have a round of calls with banks next week, lenders next week that are doing a deep dive on our valuations, and they want to be able to lend against those valuations. And that's a service that we plan to bring to our clients, that ability. Since we have all of the valuation data, what we want to unlock for them is the ability to get pre-approved on financing for whatever purpose, for growth, for bridge capital, for tuck-ins or buyouts. I mean, there are a multitude of use cases as to why you may want financing. And we want to be able to bring that turnkey to our clients since we have all of the valuation data. And so that's an announcement that we plan to make probably early in 2022. But it's a great point, Mike. That's absolutely a great point.
Yeah, and it occurs to me that if you're thinking about doing a valuation when you're ready to sell, it's too late to optimize. It's too late to improve. Yeah. And I think the really powerful thing about what Truelytics is bringing to the table, and consultants have been doing in a kind of bespoke way for a few years, is operationalizing, right, the valuation considerations and making them actionable, and making them actionable now. And as you point out, Mike, now there's a bunch of other ways to get that value before you're ready to completely exit the business, which is really new. I mean, the amount of financing that's available in this marketplace that wasn't even thought about 5 years ago, it's completely changed the landscape. Something that occurs to me, though, Ian, is so you've got all of these great value drivers, and we didn't talk about it in terms of percentage of value, but I'm sure it's pretty significant, 30, 40, 50% value premium by improving some of these things. But let's say an advisory firm checks off all these boxes and really optimizes, and they get to it and they're ready to talk to a buyer. Those buyers may have a different point of view on the value of the business. And can you talk about the differences between the way buyers and sellers look at value and how that dynamic might work, and maybe how at times if we're not realistic, that can make deals fall
Yeah,
through.
yeah. So, I mean, if you look at the stats today, I think Fidelity released in one of their M&A studies, 2 out of every 5 deals fall apart today. Okay, so just under 50%. But that's not an insignificant number, especially when you look at the deal volume and continuing to hit new historic records every single day. This presents an existential threat to a seller. And I think, again, like we've talked about before, most of these sellers are in the market for the very first time in a position to sell an asset. These buyers have been around for a while. They're very financially disciplined. And I think one of the reasons there's a disconnect between sellers and buyers are because buyers are financially disciplined. They only think in terms of free cash flow, and they predominantly think in DCF and EBOC. Yeah, and I've certainly met my more than fair share of advisors on the buy side that are doing multiples of EBITDA and things like that. And you read about these market multiples, and I think this is where sellers begin to get out of sort a little bit, because a seller will read an article about a private equity group taking out an RIA or acquiring an RIA for 11x EBITDA. Now, without questions, the multiples of EBITDA have gone up like 7-fold over the last 10 years. I mean, and that's just a byproduct of supply and demand. You have outrageous demand for a very limited supply out there, and that's going to always positively impact your valuation multiples. And how long will that go? Who knows, right? I mean, if the economy contracts a little bit, everything changes. Like a lot of you see that in so many markets. I mean, that whole supply and demand kind of reality that we think is going to be around for a long time radically changes when there are external forces at play. I think sellers, what happens is they read these articles and they think, well, all right, well, that's the market. That's what the market will bear. I should be able to get 11x multiple on EBITDA for my practice. But what they fail to understand is that those firms that are getting it are market ready today. They have top tier talent. They've been able to demonstrate long-term organic growth and stable growth rates. They have a highly diversified client portfolio, and also they're at scale. Like they're billions in AUM. They're not hundreds of millions in AUM. And I think those are the core. I mean, there are a multitude of other factors, but those are the core factors that would just generally broadly define you as a market ready company that would command a premium value multiple. Most aren't there, and most don't understand that. And so I like that whole point of if you're just doing a valuation today because you want to sell tomorrow, it's too late. Your value is your value. You're going to have very little opportunity to maximize that value. One of the things that we want to do as a company is to really move this notion of valuation being annual, semi-annual, maybe quarterly into real time. And we're doing that through incorporating API integrations into all of the core platforms that drive value, so that we have real-time signals from your CRM systems. We have real-time signals from your accounting systems. We have signals from your calendar, and we can begin to factor in with these real-time signals, real-time valuation updates. So the analogy I like to use is like when you think about the Experian credit app that you can download on your phone, you educate your kids about the value of credit, and it's a powerful app because in real time, it gives you signals as to what's going on with your credit score. Is it going up or is it going down? I mean, in many ways, that's your value. And if it's going up, that's an opportunity for us as a company to reinforce these are the things that are driving your value up, and educating the principal on why that needs to continue to be important. Are they running campaigns that have done well in diversifying their client portfolio or increasing their acquisition rates? If the value goes down, that's also an educational opportunity. What happened? And how do you remedy that? Like that's where we can become very prescriptive, real time, and use those opportunities to not only educate but train and get the principal focused back on the right priorities to fix the issue at hand. So I think that becomes a very powerful tool ultimately when you begin to think about valuation as a real time lever for operationalizing and professionalizing your practice, as opposed to just like, I need a value because I'm ready to sell tomorrow, or I need a value because of litigation or tax planning purposes, whatever. I think those that are wearing that business hat and want real-time insights into those variables that are driving value are going to be in the best possible position to maximize their value at the end of the day.
I really like the idea that by thinking this way, by using these kinds of modern tools, an advisor can begin to manage their own retirement with the same amount of care that they manage other people's retirement.
Exactly. And that's and that's one of the biggest ironies, right, in the space, is that, I mean, without question, I mean, I've met so many advisors and they deeply care for their clients. They take that very seriously. And I just find it ironic that it's like, is it the shoe cobbler's kids? They don't have shoes.
Yeah.
It's almost like that, right? So I don't.
The mechanic's
I mess
car.
up on
Yeah.
that analogy, or the reference, but yeah, their own practice, their own family, their own security is kind of their last thought, and it shouldn't be at all. So.
Yeah, and it's so interesting, and we kind of understand why. I mean, we talked a little bit about it before, but it's a recurring revenue business for most advisors, right? So it's kind of like, hey, listen, I'm going to make money next month or next quarter, just like I made money last quarter, and it might go up, it might go down a little bit, but I'm fine. So they don't. There's often not a lot of thought that goes into it, but as we've talked about, everything you do in your business, everything you do either increases the value of the business or decreases the value of the business. Make a new hire. Is that hire contributing to increasing the value of the business, or are they decreasing the value? They can, right? You make the wrong hire, it can really do some damage to the business, expanding your office space or what have you. These are real impacts. And so thinking of it that way, and I like the notion of having a real-time view of your part of your portfolio. If your business is one of your biggest assets in your portfolio, if many advisors have clients who own private businesses. They need to know what that business is worth, right? And if you're not taking that business into account in terms of helping them plan for their retirement, in addition to their marketable securities, you're doing that client a very big disservice, right? If I own a chain of gas stations or something like that,
it's the largest part of their portfolio.
Yeah,
you got to talk about it, right?
We see
really important.
Yeah, and one of the other areas, just really quick, that we see contributing to that failure rate, that 2 in 5 deals fail, is this notion that both buyers and sellers struggle in articulating value as part of a deal. And value articulation is critical, right? It's not just what the number is. It's connecting valuation and business performance, right? And your ability to be able to, as a seller, articulate value and market differentiation, leveraging peer benchmarks and practice scorecards, right? So you can, leveraging our platform, Truelytics, I mean, we expose that data to you. So we define a peer group as plus or minus 25% of your AUM. So we get really narrow. Like, these are firms of similar size to yours. And your ability to be able to kind of point to how you stack up against your peers, where your strengths are from a business, client, and revenue stability perspective, I think helps to defend your valuation at the end of the day. Your practice scorecards, to the extent that you are operationalizing value as part of your practice management priorities, you can begin to point to those things that you've done to mitigate risk. And that's what the buyer wants to hear. The buyer wants to hear, okay, I didn't just go out and hire a consultant to come up with a value and I'm going to haggle over what the number is. The buyers want to hear that you've taken very seriously this notion of maximizing earnings and de-risking the business at the same time, connecting value and business performance. I think on the buyer side, it's slightly different, but they have an opportunity to articulate how they can help the seller address risk. I think there's that equal opportunity. Both. This failure is not just on the sellers, or it's not just on the buyers. It's systemic. It's on both sides. And I think for the buyer, they can begin to leverage platforms like ours and others to be able to value a book of business and to be able to look at risk factors and be able to articulate within their value proposition, hey, we can help you de-risk that. We can help you with succession. We can help you with operating scale. We can help, like, you don't want to wear that business hat? Well, we can help with that. We'll wear the business hat. We'll let you wear the advisor hat, which is what you love to do. And so I think both have an opportunity to better articulate value, leveraging the insights of those value drivers, and everything that we've been talking about those key performance indicators. All of those can be part of a constructive dialogue in the M&A process. It doesn't have to be just haggling over what the multiple is at the end of the day.
Well, this has been fascinating. And here's the thing I know that happens after every one of these podcasts is some of the listeners and or viewers are going to be like, oh, I got to learn more about this. And also I expect there's a few of them like, oh, that sounds great, but that sounds like a total pain in the ass to do. Let's be honest, right? Because advisors, well, heck, we're all like this occasionally. Like, oh, that's going to be work, isn't it? Right.
So we're talking about unlocking $300,000 in value on average in your practice. I mean, is that worth a couple hours of your time? Is that worth a couple
That was going to be the question. Thank you for so what's the process like? I guess, relatively quickly here, kind of closing it out in like 60 seconds or less. Like what's the process like for somebody to kind of get the ball rolling, to get their valuation and start understanding where some unrealized value might be?
Yeah. So first and foremost, visit Truelytics.com. If you go into the resource menu item at Truelytics.com, you can go to the Peer Benchmark Calculator. This is a free resource, and you can immediately see how your firm stacks up against your peer. Just give us your first name, last name, provide your firm name, give us your email, and simply give us your AUM. We're going to give you a ton of value back in return instantly. You don't have to wait for a PDF to be delivered to you. Once you hit submit, we're going to show you your peer group benchmarks, and we're going to show you 3 peer group valuation averages. So that will give you some immediate insight into just in general where your firm sits and the potential value of your firm. So that's one way to immediately kind of get that ball rolling. Another way is to click contact, click get in touch, and fill out our form, and you'll hear from me. So I can ultimately what you'll get in return is we'll send you a link to a quiz where we're going to ask you some discovery questions. That sets up a 15-minute strategy call with me. Then that sets up a demo of our platform. We have pricing that is very affordable. You can license just our True Performance module and our starter license is $2,500 annually. That's significantly less than hiring a expert valuation consultant and getting one valuation. That's it. Our platform would give you the ability to perform unlimited valuations on your practice, but most importantly, give you those big data insights as to what will drive value maximization, what you need to be incorporating into practice management. How do you, if the average firm is identifying and unlocking $300,000 in value, is that worth $2,500 to you? I would argue that's a good business decision. That's a huge ROI.
Yeah.
So we can dig into their particular firm as we start to diagnose them as they go through their evaluation process and get them going, get them started immediately.
Fantastic. Well, I didn't need to be convinced that I might want to have a valuation of my business and understand it. But no, look, I understand it. There are lots of times in life where, hey, I understand this is important, but I got other things to do, right? And we kind of convince ourselves that this is a working on the business and understanding the business. It's important, but it's going to be an extra heavy duty lift in my mental state. Do it anyway, right? So hopefully we sold you. Well, listen, Ian Karnell from Truelytics, this has been phenomenal having you on the show. I really do appreciate you coming on and shedding some light on this stuff. Folks are going to want to follow up with you. Truelytics.com. Your face is down there in the right-hand corner. Click it. They can meet you. You're also active on LinkedIn and so forth. And we'll make sure we have all that stuff linked up in the show notes. Thank you very much for joining us, sir.
Thank you.
Appreciate it.
Take care, Ian.
Thank you very much for listening to and or watching this episode of the Augmented Advisor podcast. It's always fantastic to have you with us. I hope you enjoyed this conversation as much as we did. Huge thanks to Ian Karnell from Truelytics for joining us as well. I love when a guest brings actionable steps for creating value to our audience. And as a member of the audience, I hope you took notes and plan to take action on the things you heard in this episode of the show. This is really good stuff, and it's not that difficult to do. It doesn't take that much time to discover unrealized value in your business. So get on it, audience member. Okay, as I mentioned at the top of the show, please do make sure you subscribe to the podcast on your favorite podcast platform, and do us a favor. Make sure you give Blue Leaf a follow on LinkedIn and Twitter. We share every episode of the show as well as a whole bunch of other awesome stuff on those feeds. You're not going to want to miss any of it, so make sure you give Blue Leaf a follow, okay? All right, that's it for today. Please do make sure you're staying safe and be nice to each other. We'll see you next week on the Augmented Advisor Podcast. See ya!